it overlaps the session. So my apologies for taking some of your time. Okay, so now let's go on to the presentation. Okay, let me share. Okay. Let me know if the slides is not moving. Trying to share this with everyone. Okay. So hopefully everyone can see, yeah? All right, so what I'm going to talk about today is basically on what is happening at the moment, and then how what is going to happen to the stock market, and basically what are the mitigation actions that can be done. Okay, so please feel free to ask. Okay, you don't have to wait until the end of the session. Some of the terms and the things that I'm going to present may be quite technical. So please ask if you have any problems with it, and let me know where we can explain more, where you need more explanation. All right, so first of all, let me start off with the current scenario. So everybody knows that currently we are facing another global tribulation, I would say. Okay, so it started off with the US and China trade war, and then we had COVID. So it has been going on and on. And then after we have just recovered from COVID, okay, we had the Russian-Ukraine, although it doesn't really affect us, whether we are in Indonesia or in Malaysia, but we are trading partners with the trading partners of those two countries. So whether we like it or not, it does affect us. So that's the next thing that happened, and then that leads to high inflation, which I'm gonna go through in this particular session. And then just we are about to think that it's going to come down, and then suddenly the US start fighting with Iran. So now we are having another crisis, and this time it really affects us, because once the oil price is affected, then of course our daily life will also be affected. So now let's zoom in into the current scenario. Okay, so at the moment, because of the war and post-COVID activities, and then high inflation, supply shocks, we have these three significant problems that we are facing. Okay, so the first one is about rising public debt. So public debt generally increase because of COVID. So one of the reasons, okay, is because of COVID. Because during COVID, what happened is that government needs to boost the economy. We had a lockdown, okay, and then we had a lot of supply shocks. We have a supply chain breakdown. So in order to push the economy, or to get the economy out of recession, so what the government had to do is they had to spend. So when the government had to spend, okay, so that leads to increasing public debts, or rather the government debts. Okay, so that is what happening in most country in the world. Okay, this is like the post-COVID, what happens after COVID happens. Okay, and then the next thing that we are facing, again, this thing starts off, I think, around 2014, 2016. Okay, we start having some supply chain especially some supply chain issues, especially in food prices. So if you notice, food prices starts to increase around 2014 to 2016, but those were the good days. Okay, so even if the price of food increase, we do not really feel the impact. Okay, but once COVID hits, and then the war, and then right now another war, so that leads to persistent inflation. Okay, and inflation is okay if it does not affect the goods that we consume every day, meaning food, clothing, okay, healthcare. But once these goods are being affected, so inevitably our life will be affected as well. So this is the second, what we say, challenge that we are facing right now. So not only Malaysia and Indonesia, it's actually the world is facing this particular problem. Okay, and then there is a common jargon that we hear to these days, right, is called geopolitical fragmentation. So we have problems with global trade, diplomatic divisions. So these are actually disrupting the traditional economic cooperation. And if you see, okay, what happened is that nowadays we can see that countries are moving towards a free trade agreement, more and more free trade agreement. So one of the reason is because we want to contain this geopolitical fragmentation. Okay, so having these three pressures, what we call them as a triple pressure. Okay, this can have a few implication. So one implication is we might be facing stagflation risk. Again, this is not certain. It might happen, it might not happen. Don't say after this, oh, Zahira said this is going to happen. No, not necessary. But these are the risks that we face when we are facing this triple pressure. Okay, so the first one is stagflation risk. Okay, what is stagflation risk? Stagflation risk means that there are two things happening together. Okay, one, we have high inflation, but the economy is not growing. So that is what we call as the stagflation risk. Okay, under normal circumstances, when there is economic growth, normally there will be a little bit of inflation. So that's pretty normal. But what we are afraid is if we have high inflation, but then our growth is not increasing. So that is where the problem comes. So that's the first problem if we have this stagflation risk. Okay, and then the other implication is that when there are increasing friction between fiscal and monetary strategies. So which one do we want to implement first? I'll go through that in a moment. Okay, so these are the challenges that we are facing today. Okay, all right, now let's look what I've just mentioned just now. Okay, about the policy conflict between monetary as well as the fiscal policy. Okay, so under normal circumstances or traditionally, okay, so we normally use both monetary as well as fiscal policy together. Okay, so normally when there is high inflation, what we do is that the central bank will reduce the inflation rate. Okay, so when they try to reduce inflation rate, what they will do is they will increase the interest rate. So that is how it normally works. Okay, and then, okay, on the other hand, fiscal policy will be used to stabilize the debts. Okay, so under normal circumstances, these two things will work together. Okay, but then today, okay, nowadays, we have some additional factors, which is the geopolitical fragmentation as well as the supply shock. Okay, supply shock happens, for example, when there is the Iranian war, okay, and then the petrol, okay, the oil cannot be transported. So that is an example of a supply shock. Okay, so when that happens, okay, these two monetary and fiscal policies may not work, okay, because this is no longer a normal circumstances. Sometimes there will be what we call as the policy loops. Okay, and then let me get into the supply shock, for example. Okay, the supply shock nowadays is becoming more and more frequent. Why? Because of the war. Okay, remember we have two consecutive war. So that actually makes supply shock more and more severe. It's frequent and then it's severe. Okay, and these two things, they lead to very overwhelming. It becomes very overwhelming. So the traditional policies no longer works. So that's the problem. Okay, and then we have another problem of geopolitical fragmentation. So we have a lot of things going on, okay, geopolitically, okay. So that actually prevents international coordination. So that's another problem, or I would say a serious problem that we are facing. Okay, a very simple example, okay, of geopolitical fragmentation. Okay, for example, especially in Malaysia, we are going towards green energy. Okay, we are recycling, we are implementing circular economy. But then some So we are really big on, saving the environment and so on. But then at the other part of the world, okay, they bomb people, things like that. So this is what we call for an epitome of geopolitical fragmentation. It's very hard to coordinate policies. We want to save environment, but then on the other side of the world, they are having war. So this is a clear-cut example of geopolitical fragmentation and how it affects policy coordination. Okay, all right. So we can see this transition. Okay, these are the changes that happen. Okay, in the past, for example, we call them the post-Bretton Woods area of cooperation. So we had before Bretton Woods, we have very high volatility period. But then after post-Bretton Woods, which is after 1970s, okay, we have this era of strong global coordination. Okay, during that time, supply chain was relatively stable. Why? Because we just move from volatile period to a more stable period. Okay, so during that time, I'm talking about the post 1970s. Okay, we can see that the supply chain is more stable, it's predictable, so we can forecast what's going to happen in the next few years. So that means what happened is that it becomes very stable. Okay, and when things are stable, when the supply chains are stable, okay, it will be easier for countries to coordinate, coordinate collaborations and so on. Global coordination becomes very much stronger, as well as they are being more aligned. Okay, so when these two things happen, when we have a very stable, predictable supply chain, and then we've got good policy coordination, okay, so that would lead to policy efficiency. So we have very high policy efficiency as well as efficacy. Okay, but what we are facing today is we have a new era of fragmentation. Okay, we have trade fragmentation, we have supply disruptions, we have geopolitical tension. So these are the things that is plaguing us at the moment. Okay, so what we can see today is that the public debt is increasing. Okay, we have persistent inflation. Okay, we have geopolitical fragmentation. Okay, and then we have the failure of traditional tools, which I have mentioned just now. Okay, so if we were to compare with what happens post Bretton Woods in 1970s, okay, we can see that now the supply chain is disrupted. Okay, why? Because when there's a war, supply chain will definitely be disrupted. Okay, and then again, when there's war, global coordination will also be weakened because of tensions and so on. Okay, and if these two doesn't work, then when it comes to policy efficacy, it will be much lower. All right, so this is our worry right now. But don't worry, it's not the end of the world. There are still ways to navigate the problem. Okay, it's just that we need to be aware of what is happening around us so that we can take mitigation actions. Okay, so whether we like it or not, okay, we need to face this new global reality. Okay, so there are three things that we need to accept within us. Number one is that we have supply shock. Okay, so whether we like it or not, there will be increasing disruption affecting global movement and availability of goods and services. But at the moment, I think the Asian region still okay. We still do not have a major supply disruption as of yet. Okay. Okay, but when it comes to fiscal pressure, okay, we have growing strain on government budgets and public financial management. I think most countries are facing this problem. Okay, because government debt is increasing. So of course there will be fiscal pressure. Okay, and then number three, the third problem or the new norm, I would say, is inflation persistent. Okay, so in Malaysia, our Department of Statistics, they usually revise the base year. So it looks like inflation is not high. But if you're living in Malaysia, you can feel the price have gone up. Even in Indonesia, I think the price have also increase slightly. My favorite, not to say one of my favorite place to eat is Esteller. I like to eat the Esteller. Okay, so we can see the price increase. I've been eating Esteller, I think, since 2010. Okay, and we can see the gradual increase in price. Okay, so that is an example of persistency in terms of inflation. So this is our new norm. This is our new norm, and we need to act accordingly based on what is happening within us. Okay, all right. So coming back to what I've mentioned just now. So just now we were talking about how the traditional uh, policy mix between monetary and fiscal policy doesn't work. So this, now I'm going to show you how it clashes. Okay. All right. So we have, for example, the central bank. Okay. So what the central bank will do is that central bank will increase the interest rate in order to fight inflation. Okay. All right. So when that happens, if you look at the inflationary pressure returns, the combination of debt and deficit triggers a return of inflation, restarting the tightening cycle. So although the central bank have increased the interest rate, it will not necessarily lead to lower inflation. So that is where we call as the uh, policy loops. Okay. And then what happened is that debt burdens also begins to increase. Okay, when we have a high interest rate, what happens is that debt servicing will be higher. Okay, so when debt servicing is higher, so the debt burdens become higher. So this is where the conflict happens. Okay, all right, and then the next problem is, okay, fiscal spending remains high. Okay, so when fiscal spending is high, so when you tighten the monetary policy, so we cannot get the results that we want. So there will be a policy clash in some sense. So that's why the traditional policy mix is no longer useful. It can still be used, but it can no longer solve the problem. We need to have other actions in order to mitigate all the problems. Okay. Okay, now let's compare what happened, okay, during the years. All right, so for example, if you look at, I put this historical timeline, okay? So in the 1970s, we had this, what we call as the 1970s oil shock. Okay, so this is like a kind of crisis period. Okay, so when the oil shock happened, okay, what happened is that the OPEC countries, they inevitably increase the oil price. So when the oil price increase, so there will be supply disruptions. Okay, and the outcome was again inflation. All right. And then in 2010 onwards, we have what we call as the successful coordination area. So we have a lot of globalization, we have a lot of trade going on. So when a lot of trade going on, what happened is that we have more international cooperation. So when there's more international cooperation, we can have stable supplies of goods and services, and we are able to manage inflation. Okay, so one of the reasons why we have EU, because EU, they collaborate within the countries so that they can have one fixed inflation. So that's one example of policy coordination. Okay. All right. So the primary driver was globalization because the exchange of goods and services increased tremendously. Okay. But at the same time, inflation can still be controlled. Okay. And then we have another era, which is called the post-pandemic shift. Okay, so this era is what we call as the new disruption era. Okay, so during this time, that means 2020 and above, okay, we have supply chain breakdown, we have geopolitical conflicts, okay. So even the word that I've been coining from the start, geopolitical fragmentation, that only come about 2022 and above. Okay, so this is something relatively new. Okay, so the primary driver of the post-pandemic shift was the chain breakdown due to COVID and war. So we have two consecutive wars going on. Okay, so as a result, what we get is persistent inflation. In the past, we can control inflation. We can still overcome inflation. We can tame inflation, in other words. But then the post-pandemic shift, which is after 2020, inflation becomes persistent. Okay, so what happens? So modern fiscal expansion and war have caused inflation to become a lasting challenge. So that is what is happening to us. Okay. All right. So the question is, okay, what do we do? Okay. Or what can we understand from what is happening? So we know that this is the new norm. Okay. What is our new norm? That means policy is weakening, inflation has become persistently structural. Okay. Geopolitics is now drive the macroeconomics. I will show you afterwards how in our market, how all these things affect the stock market, for example. Okay. So the World Bank, okay, I forgot what the name of the person who wrote this. She was telling that macroeconomic stability is no longer a national objective. It has become a public goods. Why? Because of this ongoing geopolitical problems. Okay. So what do we need to do is that we need to maintain economic balance. Okay. How can we do that? We need to have a collective international responsibilities. Okay, only then we can share our global prosperity. Again, it's easier said than done. Okay, all right. If things are very easy, then there will be no war. All right, so these are some of the, I would say, indicators, okay, for you to have a look. Okay, so these are some of the selected financial indicators. Okay, so I will show you after this how it affects our market. Okay, so we're looking at the sovereign spread, So this darker column here, so this is where the war is happening. So if you look at the timeline, so we're looking at the past 3 months, okay, from February, March, and April. Okay, the war started somewhere in late February during Ramadan. Okay, so we can see how volatile it has been, or the changes. For example, the S&P 500 index level has gone down, but then it recovered. Okay, and then the dollar index, okay, have been fluctuating, okay, compared to the previous months. Okay, and then we can also see the market implied policy rates, how they have changed. Okay, and we can look at the size of the difference. Okay, and then we can also look at the shift in terms of inflation forecast. So that means we are expecting a higher inflation at extended time. Okay, so from these two diagrams here, so we can see the difference between United States and the Euro area. So in United States, of course, this is where the root of the war coming from. So that's why it's a bit higher. Okay, the Euro area, okay, there is an increase in expected inflation, but if you look at the peak, it has lowered. So that means it is spreading more, okay, towards a higher inflation rate. Okay, but for the United States, we are expecting around 3.5% for the new forecast rate. Okay, in the Euro area, we are targeting or expecting around 3% increase in interest rates. Okay. All right. So again, the war affects energy usage. So we can see that, for example, the global energy intensity, total energy consumption per unit of GDP. So over the years from 1980s to 2000, okay, we actually see that total energy consumption per GDP have decreased. So that means, in other words, we are saying that energy is being used more efficiently. Okay, and if we look at the energy consumption by source, we can see that oil is actually going down, okay, and renewables are increasing. So this is a positive sign towards more sustainable environment. Okay, all right. So if we look at coal, gas, so they are decreasing. Gas is slightly on the rise. Okay, Nuclear is, I would say, quite stagnant. Okay, this is one of the affected countries. Okay, so Qatar is one of the countries that exports LNG or liquid natural gas, and we can see that there is a sharp downturn in liquid natural gas. Okay, because of the war. All right. Okay, and then if we look at the market price for fuel, okay, so we have between March and April. Okay, so we can see some fluctuations. Okay, and the one that is heavily affected is, of course, diesel. So we can see that most countries, even Asian countries, we can see that the diesel price have increased significantly. But the government responses will be different from one country to another country. Okay. Unleaded petrol is relatively, I would say, relatively stable. Of course, we can see some decrease, but it's relatively not as bad as the fluctuation um, in diesel prices. Okay. Okay, so now let's look at the differences between oil importer and exporters. Okay, so this is where the problem lies. Okay, and the source of our supply shock. Okay, or supply chain disruption. Okay, so we can see that the net exporters are basically the countries that are affected by the war. So that's why we can see the increase in the price of petrol and so on. All right, but then the net importers, only 3 countries are affected. Okay, but if you look at the oil refinery disruptions, okay, it happens not only in the Middle East, okay, from this diagram here, but it also happens in other parts of the world. So this shows the connectivity or the impact of globalization. So although one place is affected, but it does not affect only this place, the war hit areas, but it will also affect other refineries. Okay, so the disruption actually happens everywhere. If you have a question why it happens, because sometimes, for example, in Malaysia, we produce and we refine our oil locally. But then there are some other countries, they produce, but they send it elsewhere for refinery purposes. So that's why, although the war only happens in the Middle East, okay, but the disruption happens everywhere else, whereby these places are connected in terms of the country that produce and the country that refines the oil. Okay. All right, so these are some of the things that you may be interested to look at. Okay, I will go. One is the VIX. VIX is basically what we can call as a fear index. Okay, all right, so it's based on the S&P 500. Okay, so we can see every time we have a crisis. For example, this is where COVID happens and all the other wars, we can see that there is a sharp spike. Okay, I'll go through this again in a minute. Okay. All right. So there's also another quite important an aspect that is increasingly becoming more and more important. Okay. All right, so we are looking at non-bank capital. Okay, so non-bank capital is on the rise. So for example, in countries or what we call as emerging markets like Malaysia and Indonesia, for example. Okay, so we have around 4 trillion worth of non-bank capital. Okay, and this non-bank capital is about 80% of the portfolio flows. And so you can imagine the size and how it can actually result in changes. It can result in changes towards the financial market. Okay, so when the amount is large, okay, so that means it will become very sensitive towards any shocks, especially the global shocks. So what we need to have now is a new policy framework that can cushion any kind of global shocks. Okay, so if we look at this non-bank capital. This non-bank capital, normally we are referring to investment funds. We're looking at insurance, okay, to some extent. So these are the examples of non-bank capital, okay. All right. So they have both. They have benefits growth, but they are also subjected to volatility risk. Okay. So these are the things that we need to bear in mind. But again, I would say if we need to grow, that means we need to take risks. It's okay to have a lot of non-bank capital, but there must be rules and regulation to regulate. Otherwise, if it's not being regulated, okay, it can lead to crash. Okay. Okay, it can crash the financial sector, but it will also affect the real sector. So that means we need to be very careful. Okay. All right. So growth, I think everyone is familiar. And then if we are talking about volatility, there's something called the volatility trap. Okay, volatility trap is, for example, a portfolio that flows are far more sensitive to global risk compared to traditional bank flows. Why? Because of the terminology called hot money. After this, we will look at the difference between uh, investment, FDI, as well as hot money. Okay. So how do we mitigate this problem? Of course, this is something commonly what is expected from you to do. Now, number one, we need to strengthen the buffer. That means we need to have adequate fiscal reserve. We need to have institutional quality to attract long-term stable investment. Okay, so that means we need to have a good infrastructure in the country. Okay, and then secondly, we need to be flexible when it comes to policy. So for example, we can have exchange rate flexibility, we can have macroprudential tools, okay? So these are necessary to manage any kind of capital reversal. Okay, small amount is okay, but huge capital reversal can be detrimental to the financial sector of a country. Okay, and of course, we can always implement stress tests, okay, system-wide stress tests. We can do simulation in terms of economic shocks, okay, so that we are more prepared for anything to come. Okay, all right. So at the end of the day, okay, these are the three main implications. Number one, now we are facing high input prices, and we also face supply shortages. Okay, so this will result in inflation or higher inflation, and at the same time, it was going to constrain our demand. Why? Because goods and services become more expensive. So in a way, it will constrain our demand. Okay, and then the second implication is that there will be shift in inflation expectation. So when there's a shift in inflation expectation, so this can trigger costly inflation process. Okay, and then number three, okay, if we have tighter financial condition, so emerging market will have spreads and a stronger dollar. Okay, and all these things is going to spill over the financial sector. Okay, regardless which country you are, so it's going to affect somehow towards the financial sector. Okay, alright. Okay, so the next thing is that we need to look at the interest rates. Okay, so why is interest rates important? Okay? Although we have Islamic finance and so on, we still cannot depart from the interest rate. Okay, right. So interest rate is okay, but if there is a global interest rate hikes, there will be implication on both the macro financial dynamics as well as the market and equity performance. Okay, all right. So when interest rate increase, it's going to result in changes in the capital flow. Okay, so one of the implications that we are going to face in the ASEAN countries is that it will alter the movement of capital flows in and out of ASEAN. So that's why looking or being sensitive towards the global interest rate hikes are very important. Why is it important? Because funds will flow to where interest rates are higher. Why? Because these people are trying to make money. Okay, so the higher the interest rates, that means the more money they get. So countries with higher interest rates have a tendency to have higher capital flows. Okay, especially in terms of hot money. Okay, and then the second implication on the macrofinancial dynamics is the currency dynamics. Okay, interest rate changes, it will trigger fluctuations, okay, of the currencies. So you can expect changes if there are changes in the global interest rates. Okay, and if we look at the market and equity, okay, we can see that the global uh, volatility rate, they can affect the market and equity performances. Okay, so it will have some impact on the equity market. Okay, and the other implication is that the cost of borrowing will also increase. Okay, so once the cost of borrowing increase, that means there is a tendency for the financial ecosystem to also reshape itself. So although it seems that, oh, it's just an interest rate hike, but the implication is much more than what we can imagine. Okay, okay, so now let's try to understand it. Okay, how the mechanism flow or how the transmission mechanism actually works. Okay, so for example, so all these are example of cases. Okay, so let's say the US increase the interest rate. Okay, so when interest rate increase, what happened is that the currency or the USD currency strengthens. Okay, higher interest rate. Okay, so it's going to attract capital coming into the US. Okay, and this okay, will lead to higher demand for US dollar. Okay, so the US dollar will appreciate or it will strengthen. Okay. All right. So next, what happened? There will be capital outflow from other countries into the US. Why? Because it seems or it looks like the US is more attractive. It's going to give you better returns. So it's going to be, there will be an outflow from other countries into the US. Okay. And then what happens? The countries where there are capital outflow, there will be currency depreciation. Why? Because the fund exits, so it weakens the market, so it weakens the currency. Okay, so we can see the currencies in those countries will depreciate. So that is going to lead the equity market pressure when there is an outflow of capital plus weak currency. Okay, so the local stocks will be weighted down. Right, in other words, our stock market will become not very healthy. Okay, so that's what it means. Okay, all right. So what is the underlying logic? So basically, if the US interest rate is high, that means it will increase the opportunity cost of investing in emerging markets. Okay, so on the other hand, what happened is that it will lead to capital reallocation back to the US. Why? Because it's more profitable, to invest in the US rather than in other countries. Okay, all right. So it will put downward pressure on the local stock markets. Okay, all right. So this is another depiction of how it works. So we can say that we can divide them into two phases. Okay, so the first phase is that we have the catalyst and the shift. So when the US interest rate gets higher, okay, so there will be higher discount. Okay, so capital shift to the US assets. Okay, and then when it comes to the other countries or the emerging market, okay, liquidity is withdrawn from the equity market. And what happens is that equity valuations will decline. So that is basically how it's going to affect our equity market, such as the stock market. Okay, so that's the first way how things happen. Okay, we can also have another channel where the same thing can happen. Okay, so for example, this is what we call as the capital flow channel. Just now, it was the equity flow channel. Now we're talking about the capital flow channel. Okay, so for example, the US interest rate increase. Okay, again, the currency, USD currency increase, so there will be capital outflow. Okay, other countries will face currency depreciation and the equity will also fall. So this is what happens in emerging markets like Malaysia. So in those countries, we can expect a downturn in terms of the stock market, unless it stabilizes. Okay, so wrapping up, okay, we can see the impact. Number one, when interest rate increase, there will be liquidity shock. So we have less money. When there's less money, we have lower stock demand. Okay, and the impact number two, capital flow dominates fundamental. So market fall even when the economy is fundamentally strong. Okay, so having a strong fundamental is necessary, but it will not necessarily ensure that capital will not go out. Okay, and then the third impact, currency matters more than earnings. Okay, if the foreign exchange market loss, that is going to trigger foreign to exit. Okay, so if the portion of foreign investors is large, then it's going to affect a lot more. For example, the Mexican and the UK market. Okay, their foreign capital or foreign players is about 50%. So any exit is going to have a huge impact. Okay, and then number four, emerging markets move together. ASEAN markets highly synchronized during market tightening. Okay, so this is one of the behavior of the ASEAN market based on my observation. But again, it can change. Okay, it will change. Okay, so what to expect if we have an interest rate hike or increase? So there will be outflow, there will be volatility, okay? And then we would expect some defensive sector rotation. Okay, so this is how the market responds when when things are happening in a not so favorable way. Okay, so for example, the Indonesian market is high risk, high return. Okay, they are more sensitive to the global market. Why? Because one of the reasons is because the portion of foreign investors is larger compared to Malaysia. Malaysia is relatively more stable because we have a lot of institutional investors, okay, which account about approximately 40%. Okay, so institutional investors, they do not switch so easily. Okay, so that is what that keeps the stock market relatively stable. I'm not saying it's perfectly stable, but it's relatively stable compared to other markets. Okay, all right, so this is just mere observation. So the Indonesian stock market, the main stock market, is very quite sensitive to foreign flows. Okay, if there are currency depreciation, that can actually increase the outflow. Okay, so this is something that probably needs to be looked upon. Okay, so when there is a tightening monetary policy, there will be high volatility. Okay, and because of this high volatility, that's why you have a high beta. High beta means high volatility. Okay, so this is from trading view. So you can see from 2018 to 2026. Okay, so this is the behavior of IDX composite index. Okay, all right, so it's actually, I would say, quite normal. Okay, the fluctuations are relatively normal. So we can see a big dip during COVID-19, another big dip when there's problems here, and then another big dip here, which is the war. So the trend is similar to other parts of the world. Okay, all right, so we can see some patterns, okay, of the IDX composite index. For example, in 2024, okay, the composite index actually increased 4.09%. When other people are decreasing, it actually experiences an increase. Okay, so 2024, we have negative 2.65 approximately. Okay, so this is because of tightening pressure phase. Okay, so historically, we can say that the IDX composite is quite sensitive to global shocks. Okay, And the key transmission channels, okay, presumably for Indonesia. Okay, so we can see that when we're looking at capital outflow, okay, Indonesia is relatively dependent on foreign portfolio flow. So if the US increase the interest rate, so we can see that investor will shift back to the US. So when the investors shift to the back to the US market, we can see that the equity selling pressure will increase, IDX volatility will spike, and so on. Okay. Oh, I've actually spoken for 45 minutes. I have 15 minutes left. Okay, I'll be quick. Okay. Some of the evidence from research paper and so on, they see that Indonesian market are highly responsive to global policy shocks and uncertainty. Okay. And then the next transmission channel is, of course, the currency depreciation. Okay. So once interest rate increase, US interest rate increase, we have stronger USD. So when there's stronger USD, the rupiah will weaken. So when the rupiah weakens, that means the foreign investors tend to exit. Okay. And then the third transmission mechanism is, of course, liquidity tightening. So as we know, Indonesia is a high volatility emerging market. That means there's high risk, high return. Okay, so we have high volatility, but at the same time we have high premium. So if there is a reduced global volatility, so what happens is that the trading volume will also reduce. So that is um, the the consequences. Okay, I will skip Bursa Malaysia because that might not be interesting. It's just that we are not as fortunate as Indonesia. So we can see that we will have negative impact if we have any kind of monetary policy tightening phase. Okay, so this is how monetary policy can adversely affect the stock market. Okay, so again, the transmission mechanism is about the same. Okay, we have foreign equity outflow. For example, in 2023, our net foreign equity outflow is about 2.34 billion, which is a lot. Okay, this is because USD interest rates, US interest rate increase, and there was global economic slowdown. Okay, and then in Malaysia, we are quite different. We have portfolio reallocation effect. That means investors, they compare. Okay, so if the US have better yields, so it will be transferred to them. Okay, so there have been a shift from Bursa Malaysia to the US market. So that is how the transmission mechanism works. Okay, exchange rate sana, which is similar to Indonesia, liquidity and market activity. Okay, so we have very low corporate activity. Okay, and then we also have very weak secondary market fundraising. So these are some of the issues that we are facing. Okay, now let's look at the capital flow. Okay. So I'll just go through, I'll share the slides with you. So I'll just go through due to time limitation. Okay, so we can see that foreign funds, okay, why foreign flows, and then why they are important for investors. Okay, one of the reasons because foreign flow, okay, they can affect the market direction, they affect the market liquidity, as well as the market volatility. So that's why foreign funds are important to look for us retailers. Okay, because if the amount of foreign funds are a lot, so in a way it's going to shape the market. So we need to look at what these foreign funds are doing in order to better forecast what is going to happen in the market. Okay, all right. So the issue here or the fundamental here is prices are not driven, okay, not only by the fundamentals, okay, but they are also affected by who is buying and selling. So that's why foreign funds are important, especially in the case of Indonesia, because foreign funds are about 40%. So it will have an impact. Okay, all right. So the next question is, okay, why does the composite index, KLICI or IDX falls? Okay, although we know that our fundamentals are strong. Okay, so basically there are three reasons. One, because of liquidity pressure. Number two is because of portfolio reallocation. Okay, portfolio reallocation is very normal. Okay, every year, okay, regardless whether you are a retail investors or you are an uh, um, what kind of investors you are, foreign investors, we always look at our portfolio. So we will take out the non-profitable stocks and we will put in more profitable stocks. So that is something that normally happens. So portfolio reallocation is something that happens all the time. Okay, so we need to be prepared on this. And then of course, the third reason is because of currency translational effect. Okay, let's see if we have an example. I think I will show you an example after this. Okay, okay. Next is we need to be able to differentiate between FDI and hot money. Okay, FDI is basically long term. Hot money is portfolio money. That means if you were to compare, FDI may stay in the country for between 5 years, 3 years, 5 years. In other words, it's long term. But hot money, okay, normally is less than 1 year. It can be 3 months, can even the next day. So the movement is much more frequent compared to FDI. That means it doesn't stay in the country. Okay, so if we're looking for long-term investment, then FDI or foreign direct investment is the answer. Okay, in other words, okay, if you're fueling the stock market, so we have this hot money. Okay, so hot money is very volatile. It can result in short run market swings. It can affect our liquidity conditions. Okay, and we measure hot money or the stock market on daily basis. Okay, is it needed? Yes, it's still needed because FDI have their own function. Okay, and then portfolio investment have their own function. So they have different roles to play. Okay, are both which one is better, which one is worse? Okay, I would say I wouldn't make that distinction because to me FDI have its own benefits as well as what we call as the risk. Portfolio investment also have its own benefits as well as risk. What is more important is how do we mitigate the risk. So that is something that we need to look at. Okay. All right. So these early warning signs, I will go through in the next slides. Let me just skip through. Okay, so I have around 7 minutes left. Okay, so now let's compare. Okay, the foreign investors structure. We compare between Malaysia and Indonesia. Okay, Malaysia, I would say we have a more balanced investor ecosystem. So foreign ownership is about 20 to 25%. Sometimes it can go down to 15 to 19%. Okay, and then we have institutional investors. Institutional investors is about 40%, and the rest are retail. So retail market is actually quite small in Malaysia. Okay, so when this happen, we can see that domestic funds from the institutional investors as well as the retail players, okay, they tend to be considered as the market stabilizer. Okay, so when foreign fund exit, locals normally absorb the selling pressure. So, in other words, there will be lower volatility overall. I'm talking about the overall, not individual stocks. Okay. So, for example, during when the US increased the interest rate, we can see there's small drawdowns, faster stabilization. Okay. In other words, we can say Malaysia is a low beta or low risk country. Rather, we can say that is a defensive market. Okay. Indonesia, on the other hand, okay, foreign ownership, I think it differs from time to time, but normally it's between 40 to 50%, which is quite a lot. This is similar to Mexico and UK, so they have like more than 50% foreign ownership. So any drawdown will have a big implication on the stock market. Okay, so when you have a very huge foreign sector, the market will be sensitive towards the global liquidity and the risk sentiment. So we really need to observe the risk sentiment. Okay, if there is foreign outflow, we can see that the IDX will see a reduction. Okay, when there is foreign inflows, we can see the market will have a rally. Okay, what we call as the bull market, going up, 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 up. Okay, so Indonesia is more aggressive, I would say. There we can consider is a high beta ataupun high risk, high return kind of market. Okay, so for energetic investors, this is a good market to invest compared to the Malaysian market. Okay, and then next we need to have a look at why currency movement is important. Okay, so let me just give this an example. Okay, so for foreign investors, their total return will be basically the equity return as well as the currency return. So for example, okay, let's say if you invest in Malaysia, you get an equity gain of 6%. The US increase the interest rate, so Malaysian ringgit depreciates by 3%. So overall, the USD return is 6 minus 3, you get 3%. Okay, this is just an example. Okay, let's say in terms of Indonesia, equity gain is about 12%. Okay, rupiah, let's say depreciate by 10%. So when we adjust, we get around 2%. So if you are a foreign investor, where do you put your money? Of course, you will put your money where the return in USD or the overall return is higher. Okay, all right. So why this currency movement is important? Okay, because foreign investors normally they benchmark in USD. Okay, why? Because USD is the world currency. So we need to introduce another currency that is as strong as the USD. Okay, so currency weakness, it will reduce the real return, and that will also trigger capital outflow. So in other words, the point that I'm trying to make here is that foreign exchange risk is often the primary driver of foreign capital movement, not the fundamentals. Although your fundamentals are good, but if there is any movement in the currency, so that will also lead to the movement of the foreign capital. So that is something that we need to absorb. Okay. All right. Okay. Sectors more resilience during global tightening. Okay. So, for example, Malaysia, if they have a defensive resilience sector, for example, the energy, plantation, banking, okay, the more vulnerable sector will be technology because it has a cyclical demand, okay, and consumer discretionary. Okay, and then in Indonesia, we have commodities banking. Okay, the vulnerable section will be the stock growth, foreign heavy, large caps, and import dependent sectors. Okay, one moment, MC, a little bit more. Okay, and then we have cash flow, commodity outperform, and growth and speculative stock underperform. Okay, let's skip to the practical things that we can do. Okay, all right. Okay. Okay, let's say, okay, we have a crisis. So I think this is quite important. Okay, so what we need to have, especially if you are a retail investor, you need to have a crisis navigation model. So I have put them into 4 steps. Okay, first you need to read the signals, and then you need to monitor the regional transmission. Then you need to adjust your portfolio, and then you need to stay disciplined. So this is how you can mitigate any kind of crisis. Okay, all right. So for the first step, what are the things that you need to observe? Okay. Okay, so I've listed 5 important or common, not important, commonly observed indicators. Okay, so the first indicator is the USD strength. Okay, so if we have a USD, a rising USD, that means there will be global stress. Okay, why? Because when USD is strong, capital will flow back to the US. Okay, second, you need to look at the US interest rates. For example, you look at the 10-year Treasury yield. So when the yield is higher, that means global funds will shift back to the United States. Okay, and then you need to look at the currency movement of Malaysia and IDR. So early sign of capital flow. So normally the currency will weaken before the stock market decline. So that is one indicator. Next indicator, you need to look at the foreign fund flow data. So if there is a sustained flow, that means that is a red flag. So you need to be aware that is a warning sign. Okay, and of course you look at the VIX, S&P 500 fear index. So if you see a very high volatility, then that signals an incoming problem. Okay, so these are some of the example. Okay. All right. So when you're looking at VIX, okay, so this is how you interpret VIX. Okay. If VIX is less than 15, that means the market is okay, stable. Okay. If VIX increase 15 to 25%, that means you need to be caution. Anything higher than 25%, that means there is a crisis mode. So always monitor your VIX. So this is an example of VIX. Okay, so anything that is above 25%, so you need to be careful because that is the crisis mode. Okay, so the key takeaway here is that volatility will increase before any major sell-off, not after volatility increase. Okay, so these are the things that you need to monitor on daily basis if you are a retail investor. Okay, all right, and then finally, you need to look at the global sentiment. Okay, why? Because ASEAN markets are very susceptible to global sentiment. Okay, so for example, when there's a US-Iran conflict, okay, there will be oil shock, then the federal rates will adjust, okay, and of course there will be inflation. Okay, so these are the things that you need to look at. Okay, all right, so again, how do you detect crisis? In summary, number one, look at the global signal. Look at the USD, okay, look at the yields, look at the volatility of VIX. Okay, and then secondly, you need to look at the regional transmission. So are there any currency depreciation in Malaysia or Indonesia? Okay, what about the foreign outflows? Okay, and then third, you need to look at the market impact. Okay, is there any equity sell off? Okay, what happens to the liquidity? Is there any sector rotation? So these are the early signs where we can detect the crisis. Okay, so finally, how do we mitigate the crisis? Because these are the textbook step by step, but you can still use them. Number one, you reduce risk. Okay, and then you trim your beta stocks. You try to avoid speculative sectors. Okay, go for the blue chip sectors. And then number two, you shift to defensive assets. Again, blue chips are defensive assets. Okay, or you can move to dividend stocks, banks, commodities. So you need to reallocate your portfolio. Okay, and then of course you need to monitor your currency. Okay, and then um, and then finally, you must be calm. Okay, you must avoid panic selling. Okay, okay, and you must avoid FOMO, fear of losing out. So that's another thing. If you want to be a good investor, you must be relaxed and you must act accordingly. Okay, so the takeaway for this crisis mitigation is that crisis do not start in the stock market. Okay, this normally start in currency. Okay, that's why you need to monitor the currency. You need to look at the interest rates and you need to look at the capital flow. Only by understanding all these three movements, okay, only then you can start your crisis mitigation. So thank you very much. I'm sorry I've exceeded the allocated time by 4 minutes. If you have any questions, please feel free to ask. If I can answer them, I will answer. If I cannot answer, I'll get back to you later. I'll share the slides with Miss Kazia or Phillips after this. Okay, back to you, the two pretty MCs, Jessica and Vanita.
Thank you to Professor Dr. Noor Zahirah for the very insightful presentation. We would like to once again thank Pyramida for their full support in making this event possible.
And next, we will move on to the Q&A session.
For attendees who wish to ask a question, please raise your hand first. Please note that every person can only ask one question.
And we will select the best questions, which will receive recognition at the end of the event.
Diana Hartono, please turn on your camera and introduce yourself first, then you may ask your question.
Hi, Dr. Noor. Can is my voice looks clearly right now?
Yes, we can hear you.
Yes. Okay. Thank you, Dr. Noor. I'm Diana. Currently, I'm working at my bank, which is from Malaysia also. Yeah. Um, my question is, during the geopolitical tension in the nowadays, yeah, what is the best strategic allocation asset that maybe Dr. Nur can advise to us as a retail investors? And also, do you think that the CPO in futures on Bursa Malaysia, because we also seek the index here from the CPO of Malaysia, can influence the global palm oil pricing for the benchmark. And I think because the war, the price of the CPO will be rising higher, including in Indonesia, because we put CPO also for the derivative for the oil, because the price of the oil is going higher. Thank you, Dr. Nur. Thank you, committee.
Okay, thank you very much, Diana, for the two insightful questions. Okay, for the second question, CPO, I don't think Malaysia has the ability to really affect CPO because basically our market is quite small. Okay, although the yield per hectare is high, but then in terms of export, we are still not that large. Indonesia is even larger. Okay, so I might be wrong, but I don't think Malaysia can actually really affect the price of CPO. But on the other hand, if you look at what is happening globally, so there is a potential for CPO prices to increase, especially with the war going on. Okay, there might be reductions in terms of oil exports, sunflower oil, soya oil. So that is actually an advantage to us, Malaysia and Indonesia, in terms of exporting CPO, palm oil. Okay, and then for the first question, can you repeat the first question?
Yes, what is the best advice maybe for us,
Okay.
yeah, the retail investor to do the strategic allocation, during these days?
All right,
Okay,
thank you.
thank you.
Okay, it's actually a difficult question for me to answer. Okay, because
No, I'm
basically,
confused already.
because personally, I'm a very low risk investor. So when the market is very volatile, okay, as a retail investor, I tend to go for the safer assets. Okay, it's either I invest in blue chips and I invest in things like that where where it is a lot safer, like unit trust and so on. Okay, I do still keep some shares in the stock market. But then for other retailers, it really depends on your risk appetite. Okay, and it also depends on the capability of assessing whether the stock is worth buying or worth investing. Okay, and then in Malaysia, for example, we have groups that analyzes the market. So they go together in groups for retail investors. So by joining these groups, they can actually form a kind of prediction as to whether the stock is okay or not. Okay, but then again, from my experience, sometimes the fundamental looks good. Okay, but then once you enter the market, okay, something else can happen. By the end of the day, the market is always right. If you don't profit, that means you're wrong. Okay, so basically, I would say that I couldn't answer that question. Okay, because it really depends on a lot of factors, and we need to do a very tight analysis in order to determine whether where to actually put our investment. But as a rule of thumb, it is always best to diversify your investment. In other words, don't put your investment in one basket. That means you need to invest in a few baskets and in a few products rather than concentrating just on the stock market or in certain other markets. Okay, I hope I do not disappoint you with the answer, but those are my thoughts at the moment. Okay, thank you,
Thank you
Diana.
very much. Thank you.
Thank you, Ms. Diana Hartono, for the question.
And next, Mr. Didik Wahyudi, you may ask your question. And kindly remember that only one question per one person.
Good evening, Professor Noor Zahirah. I'm a
Okay.
newbie. I just started trading at the stock market just about 1 year. The second part of your lecture is really interesting for me. My question is, how can, if the central bank tightens the monetary, can you give a general guideline? What sector will be affected first, will be improving, and what sector will be like getting worse? That's my question. Maybe you can give me a general guideline that will be easy for me to remember. Thank you so much.
Okay, thank you so much, Mr. Didik. Okay, so basically when the central bank tightens the monetary policy, it means that it increases the interest rates. Okay. Okay, so sectors that will be affected when they are any kind of monetary policies going on will be the financial sector. So that includes the bank, okay, and the insurance company, and anything related to finance. Okay, so as a rule of thumb, when the central bank tightens its policy or increase the interest rate, the ones that will be affected will be the banks. So any stock market related to the bank or any financial institution like insurance company and so on will be the first to show the impact. Okay, so that is the first rule of thumb. And then the second rule of thumb is that if you want to analyze stock by stock, okay, you need to look at the debt portfolio. So if the debt portfolio comes from the banking sector, so any increase in the interest rate is going to put pressure on that particular company. So you need to look at the fundamentals of the company in order to look at the debt structure of the company. So these are the two things that you can look first when you are assessing which stock that you want to invest if in the event of the central bank increasing the interest rates or vice versa, reducing the interest rates. Is that okay, Mr. Didi?
Yeah, I wonder if we can go by sector. Is there any rule of thumb for that?
Rule of thumb, sector-wise, there are many variables that affect sector-wise. So for example, if we're talking about technology sector have a cycle. So you need to understand the cycle in the technology sector. Okay, so you need to do some study in the technology sector, for example, to look at the cycle. So once you have detected the cycle, then you will know when is the entry point, Okay, and then when is your suitable exit point? So that's one example. Okay, sectors that are not very volatile in Malaysia is basically the consumption sector as well as the construction sector. Okay, so these two sector I would say is a plateau. It doesn't change that much. So if you're looking for capital gain, then these two sectors may not be where you can get a lot of gain, short-term gain. Okay, all right, and then sectors like energy, for example, in Malaysia, we are expecting the energy sector to become profitable. But at the moment, the changes are still quite, I would say, not that much. Okay, it's beyond our expectation. Okay, so again, I'm talking in the context of the Malaysian stock market. So locals in terms of Indonesian stock market, I'm not very familiar. Okay, but that is basically the first thing that you need to look at. Okay, and of course, other sectors, other sectors also have their own cycle. So I normally advise my students, okay, you need to focus, for example, in certain stocks, okay, or certain sectors, and you need to learn basically how the cycle works. Okay.
Thank
Okay,
you.
thank you so
for
much.
sorry, Mr. Didik, but we shall proceed to the next question due to limited time slot. Once again, thank you for the question, Mr. Didik, and for the answer, Prof. Noor. Now we should continue to the next question, which is Mr. Thomason Eric Nyoto. Please open your camera and please answer your question.
Hello. Okay, thank you very much, Mr. Eric. I have to make a disclaimer. I am not familiar with the Indonesian stock market. Okay, so I would not be able to answer from the point of view of the Indonesian stock market. Okay, yeah, foreign stock. For foreign stocks, I have actually slowed down. Uh, so I cannot answer it at the moment. Okay, but however, what is happening now, especially in Malaysia, the stock market is very, very volatile, and we are not really making a lot of money. Okay, at one time we used to make money in IPOs. Okay, and some very potential stocks. Okay, but now it's quite volatile. And nevertheless, having said that, I think this is I would say a transition period. Okay, so there will be periods when we need to slow down, especially when volatility is high, unless there are certain parts or certain stocks that you monitor on daily basis, and you know where the entry and exit points are. Okay, so that will be possible for you to invest. Okay, but if you do not have time to really study the stock market, I would advise you to probably move to other portfolio, okay, which is less risky. Okay, and you were talking about portfolio allocation, okay, foreign portfolio allocation, and then for the banking assets and blue chip assets. Yeah, because mutual funds, I think is okay. Okay, but then mutual funds are not really making that much money, and you always have to revise your portfolio from time to time. Okay, even I have changed the portfolio from time to time. It's just that you need to monitor closely, okay, all your portfolios. And I don't think I can answer much on that particular question. I'm so sorry. Yeah. No, I don't buy UK stocks. Mm-mm. At the moment, I have stopped investing in other countries. US. US is, I think, the best market lah if you want to try. US is the best market because US is the best market. I would say even UK is very risky. UK, very risky.
I'm Mr. Thomason for off, but we need to proceed to the next question due to limited time. Next, we have Evelyn Nadia Hindrawan for the. Please open your camera and introduce yourself first, then you may ask your question.
Okay, thank you. Good night or good afternoon, Professor Miss Noor. I'm Evelyn and currently still studying as a third grader in high school. And my question is, if we look at the recent news, we know that the Indonesian government is facing a challenging economic situation, and the government has several national projects such as the MBG, which is a program that providing free nutritious food. And this program requires significant funding. Meanwhile, geopolitical conditions have caused oil prices to rise and the rupiah to weaken. Meanwhile, the country fiscal health is at worrying point. External institutions such as JP Morgan and also Moody's have also given a negative outlook for Indonesia. So what is your opinion on this situation? And do you think Indonesia is heading toward a financial crisis, or is this just a normal economic cycle? And maybe I'm more curious about what is the best option as young individuals or young entrepreneurs who try to run small business but still can survive through this crisis? Thank you.
Okay, thank you very much, Evelyn, for the question. But before that, I would like to respond to Eric. Okay, one of the reasons why you don't have many retailers, okay, because the portion of the foreign investors is large, about 40 to 50%. Okay, so if that number falls, that means the local retailers will be a lot more. And then that also is very much related to the policies that is being implemented by the Indonesian government. So it depends on the policy actually, why the size of the foreign investors or local investors are differing. Okay. And to Evelyn's question, I don't think we are or Indonesia is moving towards another crisis. Okay, so what Indonesia is facing right now is also something similar that is happening in other parts of at least the Asian region, the ASEAN region. So other countries like Malaysia, Thailand, Philippines, we are also facing the same problem. Okay, which is currency depreciation. Okay, and then so on and so forth. Okay. All right. Despite having all these problems, it doesn't mean that all the national agenda need to be stopped. Okay. So if the government has a good project, for example, you were mentioning about the food funding, okay, SNBK, okay, that project may have some other spillover effect. To me, by all means, you should continue. You should not stop because of the pressures or so on and so forth. Okay, as long as there is money, so the money is being spent in sectors that can actually make the economy grow. So that would be a worthwhile government spending. Okay. And then if you want to start a business, okay, I think the youngsters nowadays are very creative. Okay, they have a different way of doing marketing. So as long as your marketing skills are excellent and you have a very good product, okay, despite the economy is not doing so well, I think you have the potential. So two things you need to be very good at. Number one is you need to have a very good product, and then you must have a very good marketing. Okay, only then your product can survive. Okay, and then
Noor.
okay, did I miss anything? Any other things? Okay, okay, all right. Despite me stressing about geopolitical problems, geopolitical fragmentation, okay. So yes, these things are happening, but don't get too upset. Okay, life has to go on. Okay, so we try our best to make a living. Okay, despite all these problems. Okay, so my advice is don't worry too much, but we must be aware of this problem so that we can take necessary actions to cushion the effect of all these geopolitical tensions. Okay, I hope that answers your question, if not all, partly. Okay, thank you very much, Evelyn.
Thank you for the very insightful questions and also answers. Unfortunately, the Q&A session is over. And next,
As a token of appreciation, we will now present certificates to the speaker.
the certificate presentation will be conducted via screen sharing. We would like to take a picture with the certificate as well. So I will start. So for everyone, please turn on your cameras so that we could all take a picture. And I will start the countdown when everyone is ready. Okay, 3, 2, 1. Okay, thank you. Unfortunately, we have reached the end of our program.
Let's close today's event with a prayer. Almighty God, thank you for this session and the knowledge we've gained. Guide us to apply it wisely and bless everyone here. Amen. We would like to thank everyone who participated.
We also remind you to fill out the attendance form via the link provided. For the public, scan the left QR code, while for the UITM attendees, please scan the right QR code. The QR code is only open for 10 minutes. Please make sure to fill out the form now. Also, don't forget to check the chat box for those who asked the best questions. For speaker, Prof. Dr. Noor Zahirah, you may leave this meeting. Thank you.
Thank you, Prof. Noor, for sharing today.
Okay, thank you so much.
Sunsets we wander through a foreign town. Strangely there's nobody else around. Say you open, you try. Is that still true? You said forever, in the end I fought it. Please be honest, are we better for it? Thought you'd hate me, but instead you called and said I miss you. I caught it. Good to each other, give it to summer. I know you too, but I only saw you once in December. I'm still confused. You said for